Right. Welcome. Today I want to talk about one of the taxes, one of the important taxes, similar, which is pay as you earn. This is a tax paid by employees. Employees, those people who are employed by companies, when they get their salaries, companies are required to deduct a pay as you earn tax. So today we want to look at how do you manually do a computation. We have another lecture on using a payroll system. But for now, we just want to look at how to do it manually, what is involved, and how do you compute it. So in Zimbabwe, because of the multiple currencies, it means if you are paying your employees in US dollars as well as ZWG, it means you have two payrolls. We have a USD payroll, you also have a ZWG payroll system. Right. So I'm going to talk about these things in NSSA, medical aid, NSSA, ZIMDEF, and tax. But let me move to the next slide and give a proper introduction. So this is a statutory tax on employment income. When a company is registered in Zimbabwe, it's required automatically to register with the ZIMRA for pay as you earn. And when you employ somebody and you pay them a salary, you are supposed to deduct pay as you earn as long as they meet the threshold. Right now, what is involved? Of course, for the dual currency, like as I spoke about the US dollar in the ZWG, you have got a number of deductions that you have to do. And basically, it uses what it terms a progressive tax system, meaning to say the percentage applicable goes higher as the amount that is paid increases. So a person probably who earns $100 is taxed at a lesser percentage, probably 10%, than a person who is earning 1,000. A person who is earning 1,000 may be taxed at probably 30% or 40%. So that's what it means by progressive tax system. Right. Then now let's look at the payroll structure. So you have got gross salary. Now, the gross salary is everything that is paid to the employee, including housing allowances. If you've got housing allowances, transport allowances, school fees allowance, everything that is paid, you have to add it up, including the basic salary, to get the gross salary. Now, from the gross salary, you then deduct NSSA, which is National Employment you deduct your NSSA there, you deduct your medical aid, you deduct your NEC for you to get what we call a taxable income. From there on, you apply the tax, the pay as you earn rates, which is the percentage. So we're going to see how you apply that. Then from there onwards, you get your final pay. You then also charge as levy. Then finally, what the employee gets is a net pay, which is your gross salary, less deductions, less pay to get the net salary. Now, let's look at these individual items that are deducted, starting with NSSA. So your NSSA is 4.5 of the gross salary, but it has a ceiling. The current ceiling is 700. So let's say an employee earns 1,000. You are not saying 4.5 of 1,000. You are simply saying 4.5 of 700. If an employee earns less than 700, you are applying the percentage to the amount. So if the employee earns 500, you are simply saying 4.5% of 500. Because the ceiling is what? The ceiling is 700. Yes, for us. Subject to the ceiling, then you are making this deduction. So you calculate, then you get the amount. Let's go to medical aid, which is the next slide. Now, on medical aid, you are deducting the employee contribution. So when you have medical aid, normally companies, they pay 50%, then the employee pays the other 50%. So that 50%, you deduct it before you calculate your tax or your pay as you earn. Right? It reduces the taxable income. So if the company is paying 100%, it means no medical aid is deducted. If the employee goes and is treated by a doctor and they pay their own money, they can claim that. as long as they provide the receipts and the proof that they went and were treated and paid their own money, they can deduct that. Then you've got the NEC, which is National Employment Council, industry-based. Normally, it's 1% of the gross salary. So you also have to deduct to calculate and deduct this. Then the other thing that we have is ZIMDEF. Again, this one, you have to, again, it's 1% of gross salary, and you have to calculate it. Normally, it's said to be employer cost. It could be employer cost. If it is employer cost, it means you're not deducting this from the employee. Normally, it's paid by the employer. So ZIMDEF is not applicable to the employee. Then you've got tax credits. Tax credits that we have are blind person's credit. So you must have proved that you are blind. Okay, there should be a medical report which shows that you are blind, besides you being physically blind. And the monthly deduction is $75. The same goes for disabled persons. There should be a doctor's letter certificate which proves that you are disabled, and you get a deduction of $75 as well per month. Then we also have got an elderly person credit for those people who are still working but are now over 55 years of age. You deduct 75. So the tax credits are different. These other deductions which I spoke of, the NEC, medical aid, you are deducting them before applying the pay as you earn, before calculating the pay as you earn. The tax credits, you are applying them after calculating pay as you earn. Meaning to say, if you look at this example, let's say this was our pay as you earn. So we've got our pay as you earn, which is $236.30. Then probably we've got, in this case, the tax credit was given as $10, but the tax credit here is supposed to be $75. So in coming with the final pay as you earn, it means it will be $236.30, subtract the $10 in this case, which is supposed to be 75, then you get the $226.30. So you're applying this after calculating your pay as you earn. Now, you have got tax tables. So you've got the tax tables. We have so the taxable income. Okay, before we talk about tax table, so for you to get a taxable income on which you calculate your pay as you earn, you are simply saying your gross salary less NSSA, less medical aid, less NEC. Then you get your gross salary. Then to this you apply the tax tables. So these tax tables, I will share in this video the actual tax tables which are applicable. So you apply depending with the money or the band in which the figure is in. For figures which are between 101 to 300, you're applying that percentage. Then you deduct a certain amount. I will share the tax tables. Right. So let's have an example here. Right. Gross is 1.2. NSSA 54, medical aid 60, NEC 15, then ZIMDEF 12. But we said this ZIMDEF, let's not include it. It's paid by the employer, so it's not paid by the employee. So if we were to calculate your taxable income, it was going to be 1,200 minus 54 minus 60 minus 15 for us to get 1,071. Right. Then from there onwards, you could now calculate your payee before credit. Come to that. Then if there was a credit, in this case, this credit is said to be $10. It's not supposed to be $10 there. It's supposed to be 75. So if there was a credit, then you could deduct that credit. I'm just deducting the credit. You could deduct that credit. Now, once you have deducted the credit, you now have for the pay which is payable. Okay, so you have your net pay there. So for you to get your net pay, you could actually have 1,200, then less deductions, then less pay, which means eventually you could actually pay this employee after applying deductions. So, right, let me just keep this and go to keynote, right? So if you were to look at the key things that you have to consider is let me just apply this. So you are always applying tax credits after computing pay, never deduct credit before tax calculations. Then let's just look at the summary. Include all deductions, apply tax rates, subtract tax rates, compute net pay correctly. So basically, this is how you do it. So if you were to use the actual tax tables, let me just look up the actual tax tables which are current, so that we actually see how to compute this. Just a moment. So if we were to say tax, current tax tables, I want to look at it. So I have okay, this one is 2025. Right, let me just pick, I want to pick, let me just pick the US dollar, so that we just see the US dollar hasn't changed much. Let me just pick the US dollar. I'll pick the US dollar this period, so that you see how we apply the tax table. This is very important. So this is something that you can do manually. You can actually compute your pay as you earn manually, right? I just want to show the actual tax table for, I'm just sharing this one for USD for year 2025. I'll try to provide the tax tables for 2026, so that right. So the tax table, if you are computing manually, is divided. Let me see if I'm sharing this. Let me see what I'm sharing here. Yes, it's shared as far as, oh no, it's not shared. So let me share this. All right, it's shared now. Okay, shared. So our tax table, what it does, you can do daily tax table if you are paying your employees daily, if you are paying them weekly, if you are paying them fortnightly. But normally we apply the monthly tax table. So you would find after doing the computation, after doing the taxable income, let's just go back and want to look at the taxable income, so that we see the taxable income. Right, I just want to go to that slide. Let me just go to the slide on taxable income. Right, right. So like in this case, we have this taxable income after deducting our NASA, which is 54, after deducting medical aid, which is 60, after deducting NEC, which is 15, we got 1,071. I said ZIMDEF, we are not considering it because it's paid by the employer. What it means from there onwards, it means with the 1,071, we then have to come to the tax table and see in which bracket we're paying monthly. So the 1,071 falls in the bracket of 1,001 cent to 2,000. So what we have to do now is to multiply the 1,001 times 30%, then deduct $85. This is what we are supposed to do. So if I were to quickly, let me just probably put up a calculator there. All right, let me see if I can. So this is how we could actually do that. So I just want to put, let me put Excel. Let me just put Excel there and see if I'm able to put Excel quickly, so that I just demonstrate how you calculate that. Right. So this is if you are calculating manually, but as I said, I'll also do a lecture on using a payroll system, so that you actually see, because once you are now using a payroll system, most of these things are automated. You are not calculating them yourself. They are automated. So the system would actually calculate, you just feed some information, then the system does the computations. So let me just demonstrate how you compute. Now that we have found the taxable, so we said the taxable income is 171. This is what is taxable. And from the tax table, we saw that, let me just load up the tax table so that we again remind ourselves. So we saw that the 1,071 is falling in this bracket. This bracket, right? This is the bracket that it is falling in. So we are supposed to multiply it by 30%, then we are supposed to deduct $85. So if we were to come back to Excel, what it means is, let me just come back to Excel. What it means is, okay, sorry for that. Let me just again come back to Excel. Right. So what it means is, we could actually apply 30% to that, right? So we could actually say A1 times, let me put the term sign there, the multiplication sign, right? So which means we are getting that. Then we have to say the 321 minus $85. This is what we're supposed to do. Then we could get that. Then on this one, we are supposed to multiply by 3%, which is S11, right? Then we get that. So we could actually get $7. So which means eventually our payable in terms of payee will be 343. But if there is a tax credit, it means we have to subtract from this 243, then we are supposed to subtract the credit, which would be 75. Then which means this employee could actually pay $168 as payee. So if they were to take home, we could just say the 1,071, because that's after deductions, then minus 168. That will be the final pay which they are paid. So basically, this is how you actually do the manual computation, both for ZWG and for the USD. That is if you are paying your employees in both currencies. Thank you for watching. See you in the next video.